What if I told you the decision to pay off your mortgage early versus investing the same money could result in a difference of £200,000? Today, we are diving deep into one of the most important financial decisions you will ever make. And I am bringing the data, the statistics, and the real numbers to help you decide what's right for you. If you are a homeowner sitting on some extra cash each month, you have probably asked yourself, should I throw this money at my mortgage to become debt-free faster? Or should I invest it and let the compounding interest work its magic? Here is the thing. Most people make this decision based on emotion rather than math. And I get it, debt feels heavy, but what does the data actually say? Let's break it down. First, let's establish some baseline facts. Through this video, I'll be using S&P 500 as our investment benchmark. Now, you might be wondering why the S&P 500 when we are talking about property. Here is why. The S&P 500 is the most widely recognized stock market index, representing 500 of the largest US companies. It's the standard benchmark that financial professionals use to measure investment performance. Because it's diversified, has decades of historical data, and represents a passive investment strategy that anyone can access through low-cost index funds. When we are comparing paying off your mortgage versus investing, we are really asking, should you put your extra money into property or into the broader stock market? The S&P 500 gives that reliable stock market comparison. The S&P 500 has historically delivered an average annual return of approximately 10.3% over the last 30 years. When adjusted for inflation, that's still around 7.6% annually. Now, as of February 2026, UK mortgage rates vary significantly. The average 2-year fixed rate sits at about 4.48%, while the 5-year fixed rates average around 5%, with the Bank of England base rate currently at 3.75%. In the US, fixed rate mortgages are hovering around mid 6% range. Here is a powerful example from Forbes. Imagine you have £250,000 mortgage at 6% interest on a 30-year term. By the end of the loan, you would pay a staggering £289,000 in interest alone. Just think about that for a moment. But what if you invested that extra money instead? If you put an extra £250 into an S&P 500 index fund earning 10% annually, you could potentially accumulate £137,000 over 21 years. That's approximately £37,900 more than paying down your mortgage principal during the same period. Now, here is where it gets really interesting. A comprehensive analysis by MoneyGeek examined 43 years of data between 1971 and 2013, comparing mortgage payoffs versus S&P 500 stock market returns. The surprising result? Mortgage payoffs offered bigger returns 60% of the time. That's 26 out of 43 years. The S&P 500 only beat mortgage payoffs 17 times during this period. But timing matters enormously. Between 1997 and 2007, during the dot-com bubble and before the financial crisis, mortgage payoffs saw bigger returns, 10 times out of 11. However, during the 2008 financial crisis through 2013, the stock market won out every single year. Here is a recent real-world case. Study from 2025. One investor kept a £240,000 mortgage while investing in the S&P 500 instead. Over the 5 years, with the S&P 500's strong performance, yielding approximately 98% total returns with dividends reinvested, they generated over £235,000 in investment gains. That's more than the principal they owed. Financial experts generally agree on a crucial threshold, the 5% rule. If your mortgage interest rate is around 5% or lower, it often makes more mathematical sense to invest that extra money in the S&P 500 rather than paying down your mortgage. If your rate exceeds the 5%, prioritizing the debt repayment typically becomes more advantageous. Why? because historically S&P 500 returns have significantly exceeded the 5% over long periods. Here is an illustration of a user with their 3.25% mortgage rate. This year the S&P 500 saw a 14% increase. Would it have been smarter to pay down their mortgage or invest in the S&P 500? The answer is crystal clear. Investing would have been superior choice by a massive margin. But here is what the pure math doesn't capture: the psychological impact. And this is where the decision becomes deeply personal. According to Bankrate's latest money and mental health survey, 42% of US adults reported that money negatively impacts their mental health. For those aged 35 to 54, that number jumps to 52%. Dr. Pearl Chu, a psychology professor at Virginia Tech, explains that the debt creates a constant pull on our attention, making it difficult to focus on work, relationships, or personal goals. Being debt-free can lift that psychological burden, freeing up cognitive space and emotional energy. From a psychological perspective, paying off debt provides instant gratification and certainty. Every pound you put towards a 6% loan is a guaranteed 6% return in avoided interest. No market volatility, no stressful headlines, just predictable progress. Investing in S&P 500 on the other hand requires delayed gratification. The payoff isn't immediate, and market fluctuations can increase financial stress during downturns. But for those who can stomach the volatility, potential long-term growth can be substantial. So, how do you decide? Here are the crucial factors. Number 1. Your mortgage rate. If you refinanced when rates were historically low, say 3% or less, any money you invest in S&P 500 is likely to significantly outpace what you have saved in interest. Number 2. Your time horizon. If you only plan to own your home short term, making minimal mortgage payments while investing in index funds might be wiser, especially if housing markets are uncertain. Number 3. Your risk tolerance. Mortgage payoffs offer guaranteed returns with low risk. Investing in S&P 500 offers potential for higher returns but comes with a market risk. Number 4. Tax considerations. Using tax-advantaged investment accounts can significantly boost your returns. One analysis showed that a 1% mortgage rate and a 9% investment return in a tax-sheltered account. You could pay off your mortgage about 3 months faster through investing than through direct payoff. Number 5. Other high-interest debt. This is crucial. Eliminating credit card balances and high-interest car loans before focusing on either mortgage payoff or investing. Credit card debt can devastate your finances. Here is a strategy many financial advisors actually recommend. Do both. Consider splitting your extra cash, perhaps 60% towards investing and 40% towards your mortgage, or whatever ratio gives you peace of mind. This way, you address the emotional weight of debt while capturing S&P 500's growth opportunities. You could also prioritize employer-matched retirement contributions first. That's free money. Then split remaining funds between mortgage payoffs and additional investing. So, what's the verdict? Here is the truth. There is no universal answer because this decision sits at the intersection of maths and psychology. The math often favors investing in the S&P 500, especially with mortgage rates below 5% and historical stock market returns around 10%. But if carrying debt keeps you awake at night, the peace of mind from being mortgage-free has value that spreadsheets can't capture. Some people sleep better knowing they are debt-free. Others are more motivated watching their S&P 500 portfolios grow. Both approaches can build wealth. The question is which path aligns with your values, risk tolerance, and financial goals. What are you doing with your extra cash? Are you team mortgage payoff or team investing? Drop your thoughts in the comment below. I would love to hear your perspective and what factors influence your decision. If this video helped clarify this financial dilemma, smash that like button and subscribe for more data-driven financial content. Until next time, invest wisely and make decisions that serve your future self. Thanks for watching, and I will see you on the next one.